Thanks for joining us today on Market Call. I'm Morella Fernandez. Mike Vinokur on the show with us today. He's Senior Wealth Advisor at Propellus Wealth Partners, IA Private Wealth. He'll take your questions today on North American large caps. Here's the information to reach us, 1-855-326-6266 if you're calling in. You can email questions to marketcall@bnnbloomberg.ca. Good to see you, Mike. Thanks for coming in.
Pleasure to be here.
Thanks for making it in after the storm.
Yeah, it wasn't as bad as one would think after such a big snowfall.
Well, I'm glad that it happened yesterday.
Right.
And there's a bit of time to get the roads clear because it was a bit of a mess yesterday. Anyway, it's talking about a mess. How would you characterize the start of the year for the markets?
Well, it's been really strong, especially in the small cap, mid cap space. And then when you look at gold, silver, commodities in general, I mean, you've seen a huge rotation of capital into those areas, and they're flying high.
What do you think is driving that?
So I think there's a few factors. One, deregulation by the Trump administration has been fueling a lot of small cap space company names. Two, a rotation within the markets, potentially away from very high-flying, highly valued tech stocks, especially, software we've seen come off and some of the other areas within tech, and going into things that are more domestic related. You're seeing huge GDP growth in the US. Perhaps the consumer is a lot stronger than people thought. That should benefit smaller cap companies, especially those that are more domestically focused. On the gold and silver side, probably it's a continuation of the debasement trade of the US dollar and foreign central banks thinking, wow, do I want to own treasuries or fiat currency reserves, or do I want to own a hard metal like gold?
Okay, let's talk about volatility this year and what you expect compared to last year, because last year was volatile, there's no doubt. And I'm wondering if you think this year is going to be even more so.
We believe it will be even more so. And that's partially because of the geopolitics, partially because not much has been solved in terms of government within the U.S. I'm hearing maybe another shutdown, who knows? Partially because valuations have come up. And so one could argue that markets are no longer cheap. They may not be extremely overvalued, but they're not cheap. And so you have to pick your spots. And partially because, hey, 3 years of a good bull run, you may see a little bit of that give back, and it may happen more violently than one would like.
So what would be your broader advice for investors looking towards the year and what they need to do or how they need to position?
Well, we think that this is going to be a pick your spots year. In other words, you don't necessarily want to just throw your money into an index and have it passively managed. And maybe stock picking will be back in vogue, maybe value investing. We're seeing a big trade, a big rotation into value from growth. So we think that those themes are definitely going to continue. And we also think that the previous generals may not be the generals of this year or this cycle. And so we may see a rotation in capital flows into a lot of other previously unloved areas or areas that really haven't gotten a lot of attention.
Okay, let's take a quick break. We'll line up the first phone calls for Mike for when we come back. Here again is the information, both the phone number and the email address to reach us. We're back in a moment. Welcome back. Mike Vinokur with us today as our guest. We're going to start with an email from Jeff. He says, could I get Mike's opinion on Disney? Disney, a very different platform from where what it used to be. What are your thoughts on Disney and their business model these days?
Yeah, well, you gotta appreciate the brand power of Disney. I mean, storied brand, they do something that nobody else in the world can or does. And they do it very well. You've got a lot of very avid fans and big followers. Having said that, we're not sure that the valuation today merits capital in the stock, given the fact that their cost of running the theme parks, the personnel, is very high and probably getting higher because of cost of living. The tickets are so expensive. We are concerned that, in any slowdown of growth, people may say, you know what, I'm not going to pay that $150, $200 entry fee. The cost of production on their Disney Plus and media assets, they're constantly competing to one-up each other between Warner Brothers and Paramount and all of these other studios.
Yes.
So you got to distinguish between a great company and a great stock. And we're always, as value investors, we're looking at the value side of the equation and love the company, love the brand, but I would wait for a pullback before entering.
Okay. Let's go to our first caller, then Elliot's on the line in Hamilton, Ontario. Hi, Elliot.
Good afternoon. Mary Fraser seems to be delivering on her Citigroup turnaround. She says she's 80% of the way through. Stock looks good to me. What do you think? Citigroup going forward. Thank you.
How are you on the financials and Citigroup specifically?
Yes. Well, full disclosure, we do own Citigroup. We have owned it for a few years. Obviously, at $40, $50, $60, it was a no-brainer. Here at $115 or so, not as cheap as it once was. Having said that, the management is first-rate in our view. They have completed a wonderful turnaround. We think there's going to be a lot more in terms of buybacks, which is going to increase earnings per share. We think their credit book is very good. We love their FICC business, which is the commodities and currencies and Forex trading side. You have a very big international footprint, even though they've constrained it in most recent years to bring capital back. Very well capitalized, and I think you can definitely own it, hold it here, and we see upside to this name.
Okay. Let's go to our next caller then. Trevor's on the line. He's calling from Arizona today. Hi, Trevor.
Well, hello, and thank you. My question, Mr. Vinokur, is on Linamar, the manufacturing company, and especially in light of NAFTA or CUSMA being renegotiated and maybe, being scrapped. How does that affect Linamar? And if it does, what other sectors do you feel, squeezy about with the CUSMA renegotiation? Thank you.
Okay, thank you for the question. Linamar, of course, does products that service or provided for building automobiles and vehicles. That's generally how we think about what they do. But they haven't suffered that much, obviously, with the early tariff threats. They've surpassed and done pretty well.
Right. Thanks for the question, Trevor. So we think Linamar has done an amazing job in its operations. The geopolitics here are very hard to discount. What I would say is Canada and the U.S. are very linked in terms of the auto trade. It would take years, in our view, from what we know of the industry, to create a situation where the U.S. was no longer dependent on Canadian auto parts manufacturing and production. Could it happen in the future? Absolutely. Do we know how these CUSMA negotiations are going to go? No. But what we think is the worst case scenario is that even if CUSMA is not renegotiated in its current form, there will most likely be a level of tariff. And we think that an operator like Linamar or Magna or any of the other super well-run Canadian auto parts manufacturers are going to be able to overcome it through efficiencies in production, et cetera.
Okay, so you're not that concerned?
Not that concerned on the geopolitics. The valuation, however, is, not very inexpensive anymore, and so it's already discounted a lot of the bad news. And we think that here we wouldn't be apt to buy it. We would rather probably wait for a pullback if you were going to enter this position.
Okay. Let's go to Kevin then. Kevin's in Kingston, Ontario with this question today. Hi, Kevin.
Hello. Thank you for taking my call. My question's on Visa. It's reporting this Thursday, but I've noticed over the last year or so it's been very flat. It hasn't moved much. And I'm wondering, would you be stepping in at this price? Thank you.
Okay,
Bye.
thank you for the question. Yeah, Visa has gone pretty flat over the last little while. What's your take?
So we're not surprised. Visa is, by the way, a first-rate operation. Technology, platform, breadth, global presence. There's not much you can knock on the business. But as value investors, this is not a name that we would be attracted to simply because of the multiple. Visa has always traded at a very high multiple. And today, maybe the flat stock price is just catching up to that multiple compression. And maybe if you wait long enough as earnings grow, you may have that margin of safety or that built up upside. So there's two levers here. As the global economy and GDP increases and as inflation keeps at its clip, the nominal value of processing of sales is going to go up. So that's going to benefit a company like Visa because people are just going to be spending more money and they make a percentage of they're a toll road. They make a percentage of every dollar sold. In terms of their earnings and their moat, we have two concerns. One, their PE or their earnings multiple is very high and always has been. But two, we're wondering now whether there's some erosion in that moat to fintech competitors that may be taking share slowly for now, but accelerating that share pace. And does that warrant Visa to have that very huge multiple on a go-forward basis?
Okay, so you got to watch the fintechs moving in. All right, let's take a quick break. Mike Vinokur here from Propellus Wealth Partners, IA Private Wealth, taking your questions on North American large caps. We're back in a moment. Welcome back. Let's go to an email from Lindsay who says, my question for Mike is whether Propel Holdings is a good buy at the current price. Do you see upside in the next 12 months? Thank you. And thank you for that question. Propel Holdings, so credit lender. And I'm wondering what you see for them.
Yeah, thank you, Lindsay, for the question. Full disclosure, we do own a small position in Propel in our equity models. We like the company. We like the growth trajectory of the company. We like the evolution of their business model. We think it's very profitable. One great signal was not only the growth in earnings and the growth in revenues, but also that the board most recently, yet again, upped their dividend. Typically, boards don't do that in a high growth company unless they're very certain or quite certain of the future. We think it doesn't trade expensively, and we think that maybe part of the reason that it got hit was tax loss selling back at the end of the year, and now maybe there's some worries about the credit cycle, which is actually possible. But we think this is a very well-run company, well-capitalized, and we think that it's reasonably inexpensive at its current price.
Okay, that was for Lindsay. Let's go to Chris in Delta, BC with a question. Hi, Chris.
Oh, hi, Morella. As always, truly a great team of folks at BNN Bloomberg. I would just love to ask Mike's opinion on the healthcare sector overall. I am more of a value dividend growth type investor, and healthcare has certainly had a good bounce from the lows, but I'm wondering if there are still pockets of value that you see for a long-term 5+ 10-year time horizon. Thank you both and have a great rest of the day.
Thank you for the question. Yes, money's been rotating into healthcare and pharma.
Absolutely.
Is there one or two that you like that are still you could put money in at the level they are today?
Yes. So when you describe healthcare, there's many different facets of healthcare. You've got the pharmaceutical companies, you've got the biotech, you've got the equipment makers, you've got the HMOs, right? So let's say 4 big broad baskets. We own 2 U.S. healthcare names currently we think are very well run, and those are Merck and Bristol Myers Squibb. Both pay really nice dividends. Both we think have great pipelines of drugs. Both are inexpensive, and both have reasonably wide moats. We also hold a few positions in some HMOs. So we like healthcare in general. We think, to the caller's point, it has been unloved in the last little while. You've seen money rotate back into healthcare. We think there was a big scare with the Trump administration when he came in, with drug prices and with the HMO revamps and whatnot. We think that that rhetoric has maybe died down a little bit, especially with the deals that the administration has cut. And we think those balance sheets are great. One thing I would point out is we think the huge opportunity for healthcare is with AI. If they can use AI to their advantage to reduce R&D, to accelerate development pipelines, and to streamline their businesses, there's probably a lot of costs that can come out of those companies and hit straight to the bottom line.
So is that more for pharma and research companies as opposed to some of the others?
Yeah, probably, because these companies spend a vast amount of money on research and development and hiring very expensive people who are very well trained. But if you can increase your productivity in that sphere, then probably a lot more cash flow is going to hit the bottom line.
Okay. Let's go back to the phone lines. And Bill's on the line. He's in Mississauga, Ontario, with a question. Hi, Bill.
Hello. I'm taking a rest from the snow shovel and asking a question about a company called Fiserv. Fiserv took a big hit last fall, and they are facing a class action suit over improper reporting. However, the agencies like Morningstar are telling us that it's worth twice its current price. Would you be a willing investor in Fiserv, please? And turn it over to you. Thank you very much for taking my call.
Okay,
Bye.
Thank you for that. I'm glad you're getting a rest from the shovel at this point.
Yeah.
Fiserv, what do you think?
Okay, thanks for the question, Bill. So unfortunately, we own it. We got in a little too early. We are still holders of the stock. And I concur with the caller. The previous management was a little bit too zealous in terms of their expectations on growth and earnings. We think new management, new CEO came in, they kitchen sinked the expectations. The stock obviously took a bad hit. The company itself has a huge moat in terms of their backbone. They're the back-end processing platform for I don't know how many billions of transactions per year and work with a huge swath of the financial system. So this business is not going away. The question is, what's the valuation? While I don't know if Morningstar is correct and the stock is worth a double from here, we definitely think it's worth a lot higher than where the current trading price is. And that's why we've held on to the stock, even though we're down quite substantially on it.
Okay, so I've got for the consensus rating, so 11 buys, 23 holds, and 3 sells. And Morningstar's target price is 126. It's at 67.06 today, so they do have a pretty high target price. Okay,
Yeah.
I hope that it works for Bill. Let's go to Carl in Courtenay, BC. Hi, Carl.
Hi, how are you today?
Good, thank you.
Good. No snow here. That's on Vancouver Island, so that's nice.
Lucky you.
Yeah, I would like to ask Mike if about Tech Resources and Anglo and the deal upcoming merger. I'm not too clear on how the merger is going to work. I don't know if he can shed any light on that, but also I'm wondering if it's good for the holders of Tech right now, which the price seems to be increasing substantially, to hold on and wait for the new stock to be issued.
Okay, thank you for the question. Tech Resources, what are your thoughts?
So we don't own Tech. We do own a competitor of Tech's. We sort of stopped looking at it once the Anglo deal was announced. But probably my general commentary would be we're bullish on the price of copper. Tech is a big producer in copper. If you believe that the price of copper is going to stay here or maybe even go higher, then this company should produce more cash flow. The combined entity is probably going to be even that much better off because Anglo also has some very complementary assets, and there's probably going to be some huge synergies between those two entities. So I would say if you own the stock already, probably hang on, given the pricing environment of the underlying commodities, and you should do okay.
But you wouldn't buy in necessarily where it is today?
I wouldn't probably buy in today because in our view, a lot of these commodities have had very high recent runs, and we think that a lot of this is a little bit overbought in the short term, and so you may be chasing a little too much here in terms of the price.
Okay. Let's go to John. John's in Hamilton with a question in Ontario. Hi, John.
Hi, thanks for taking my call. Mike, I wanted to ask you about your take on CN Rail, specifically Do you own it? Would you get into it at this price? I guess what's really weighing on me is the upcoming Kuzma, the recent threats by Trump about the 100% tariffs. There's a lot of noise, and since this business is so intertwined with Canada and the U.S., I'm kind of stuck. And so there's really two questions, right? There's noise, and then there's the CN rail. So your feedback would be helpful. Thanks.
Okay, thank you for the question.
Thanks for the question, John. So we don't own CN Rail. This is not sort of our typical holding, only because it's always been so expensive. And part of the reason is because it's a great business and it's an oligopoly in Canada. You've got CN Rail and you've got Kansas, CP, Kansas City?
Yeah, Kansas City.
I forget the new name. But you know, those two major railroads aren't going away. And every year as populations grow and as the economy advances, there's more and more rail shipment, so the revenue is going to go up. But it's to my latter point on Disney, great business because it's got such a moat. I don't think there's going to be a new railroad formed in Canada anytime soon.
Yes.
Right. So the question is, if you've got scarce capital, do you want to put it into CN Rail or do you want to put it somewhere else? From our perspective, we'd rather put it somewhere else because we think that you're going to get a bigger margin of safety or more upside for the risk that you're taking as an equity investor. But nothing bad to say about CN Rail in particular.
Okay. Let's take another quick break then. We will go through past picks from Mike when we come back. Time to have a look at past picks from Mike. These picks are from Friday, March the 7th of last year. Corebridge Financial was a pick at that time. CRBG 3204 US at the time in New York and 3002 today. So a drop return of 6% and a 3% total return drop. Is this a company that you still like and are holding on to?
Absolutely. We obviously don't like the performance of the stock, but the business has been doing reasonably well. It's a steady Eddie life insurance business. We like the life insurance sector specifically because of what we see as good returns on capital, steady growth, ability to buy back stock, and a nice dividend. It's a well-run company spun off from AIG, I believe. Okay. But yeah, we still own it. We still like it.
Any reason why it hasn't done as well? It's out of Houston, right? Or it's out of Texas?
I believe so. Don't quote me on that. Why hasn't it done well? Well, there's been a lot of worries about the life cos. For example, what is their money invested in? Is it invested in commercial real estate? Is it invested in private credit? Are they going to have big defaults in their books? So people are, worried about that. Also, as interest rates drop, normally, in the past anyway, the yield on the capital of a life co goes down because the interest rate goes down, right? These life cos have been very good about investing their money in an appropriate place, generating an appropriate yield, getting a good return off of their underwriting, but also off of their investment business. And, we think that if Corebridge continues doing what they're doing, this is a very undervalued stock run by a very well managed team.
Okay, let's go to your next past pick from March of last year. Parkland, PKI on the TSX, which was acquired by Sunoco November 5th last year. 36.35 when you recommended it in March, then to 39.84 when it last traded, so 10% upside and 12% total return. I can't remember how far back the discussion about an acquisition or deal went. Did you have a heads up or an idea that it was a possible takeout here? Or
yes, because one of the biggest shareholder of Parkland was in a proxy battle, and they were I think it was Simpson Oil, and they were not happy with the current management team and the board. They were jostling for some kind of change. That change occurred. Sunoco Corp or Sunoco LLP whatever the company in the U.S. They created Sunoco Corp. We elected to have part cash, part shares, so we're now shareholders in Sunoco Corp. And we think the combined entity is going to do very well. It's a steady Eddie, solid business. It's going to be paying a dividend. And so we're happy to ride those shares.
Okay. Let's get your last pass pick then. Secure Waste Infrastructure on the TSX, SES, at $13.89 at the time, now to $17.52. So 26% upside, 29% in total return. What did you like about Secure Waste then?
So, first of all, the company changed its name. It used to be called Secured Energy or something, and it had really nothing to do with energy. It was always a more of an infrastructure company, and so it was a misnomer. We like their business because approximately 80% of their business is recurring revenue, steady Eddie cash flow. And so they've got really high returns, very nice EBITDA growth. It's very recession resistant. And the management team have been great stewards of capital, and they've bought back mounds of stock. The insiders own a decent chunk of the stock. It's one of those companies where you can see the growth year over year in terms of the cash flow. There's no issues with the balance sheet. They can keep reinvesting and keep growing. And wow, they keep buying back their stock and accreting more value to us, the remaining shareholders.
So it's one you continue to hold, obviously, and you like just because of its cyclical nature.
Actually, because of its non-cyclical
nature. Yes, of its steady nature in moving. Yeah,
absolutely.
Do they pay a dividend? Sorry, I was just trying
I believe
to
they do. I believe they do. I believe it's a very small dividend.
Okay.
That they pay, yeah.
All right. All right. That leaves it for past picks, and we'll come back with more of your phone calls from Mike Vinokur of Propellus Wealth Partners, IA Private Wealth. Back in a moment. Welcome back. Let's go to Humesh on the line from Unionville, Ontario, with a question. Hi, Humesh.
Hi.
Go ahead.
Thanks for taking my call. I'm trying to work out why BX has been not moving in either direction for the whole year.
Okay. We'll take a look at Blackstone Group here. The chart, it's down almost 20% over 1 year. What's your take, Mike, on Blackstone?
Thanks for the call, Humesh. So love the company, don't like the valuation. We never bought Blackstone. I was kind of surprised to see how far it went in the rally. I think it hit $180, $190, now back down to $150. There was this raw enthusiasm for these private equity companies as though they had found the miracle cure for their business. But, LBOs, private equity, this kind of business has been around since the 80s, since KKR and, all these companies. And there's a lot of competition in private equity and private credit. So I think because there's more competition, there's potentially less deals to be had. The deals that are getting done are potentially getting done at a lesser return. So they're taking in all this money, but you're not necessarily seeing it to fall to the bottom line. The other concern that we have about private credit, private equity is, are the marks real? In other words, are we going to wake up one day and we're going to find out that a lot of these private equity funds, Blackstone's going to have to go back to their clients and say, sorry, your net asset value is no longer 100, it's now 92 or 85 or 71 or whatever the number ends up being, and how that's going to affect capital raising in the future. And so will these companies be able to be on this treadmill of raising these vast amounts of capital and then charging fees if the performance starts to wane on their existing funds?
Okay, something to watch for Blackstone. Let's go to Bill in Bowmanville. He's got a question. Hi, Bill.
Thank you for taking my call. I'd like your guest thoughts on Constellation Software. Does he own it? If he did, what would he do with it now? And just his overall thoughts on Constellation. Thank you.
It's been hard for investors to watch Constellation go down the way it has. A number of different reasons feeding into this. Do you own it?
We do not own it. We were, much to our chagrin, we saw it on the upside and missed it, and now we're thankful that we didn't get on that train
and ride the edge.
And ride the edge, yeah. So you have to hand it to Mark Leonard. Boy, did he build a beast and executed it like a well-oiled machine. But when it hit over $2,800 or $3,000 a share, and then went all the way to, I think it hit 5,000 or something. We could never get our heads around the value because if you looked at what they were acquiring in the last couple of years, the deals haven't been big enough to move the needle. And with the threat of AI upending certain verticals in software, i.e. not making the value of the software they're buying as valuable anymore because maybe you can replicate it with a lot less cost, what is the true value of Constellation software? Because anybody can, they have a very big platform, but, you can go and buy other companies. The magic sauce was that they vertically integrated these companies, but allowed management to stay back, sort of a Berkshire Hathaway model. So, like the business, like the company, but the valuation, in our opinion, is still steep because we're concerned that they won't be able to get back onto that growth trajectory. And if they can't, then the current valuation may still be too high.
51.81 was the high, which was last May, before it started coming off to where we got today. Okay, let's get to an email from Rami. Hi there. She says, love the show. What is your take on Netflix? Is it a buy now? Thank you for that, and thank you for the question. Netflix has the cash now offer for Warner Brothers Studio, but it is in a bidding war with another company that wants to take it as well. So what are your thoughts on Netflix? Because it's been trending down since these offers started floating around.
Yeah, so we don't own it. We have started looking at it. Netflix is a dominant business, and judging by my kids and my family, we consume a lot of entertainment, and I don't think we're going to be getting rid of the Netflix app anytime soon. Sure. The other piece here is the ads. They're smart. They're starting this really nice ad business, which is very high margin, and we don't think that's going away anytime soon. So the question is going to be, this all cash offer is going to drain a lot of Netflix's balance sheet. And how are they going to pay for this acquisition if they even win the Warner Brothers acquisition? What is that going to do to earnings? What is that going to do to cash flow? It's going to take a lot of time to buy out, envelop the business, digest it, strike the synergies, see the cannibalism between the legacy Warner Brothers customers versus the Netflix customers. Maybe there's a lot of overlap, maybe there isn't. So we're looking at it, but we want to see the dust settle a little bit more on the valuation, but also on the acquisition and the synergy before we would step in.
Which could take years, right?
You hope not years, but at least a year or two before you could see the light at the end of the tunnel.
Yeah, I just think of how much content Warner Brothers must have, and trying to incorporate that would be hard. All right, we're going to take a quick break. Back with your questions in just a moment. Welcome back. Gulam is on the line. She's in Toronto with a question today. Hi, Gulam.
Hi there. Good afternoon. My question is on healthcare, the healthcare sector. I just have a very small position in QIPT. I want to add to that sector, and I have two names in mind. One is the Sienna Senior Living, and the other one is Northwest Healthcare. You think it's a good idea to get in now? And if so, which one would you prefer of the two?
Okay.
I'd appreciate your opinion. Thank you.
Thank you for the question. So Northwest is a REIT with healthcare properties, I guess.
That's right. So so Northwest Healthcare is an interesting mix of assets. They own medical office buildings in Canada. They own hospitals and other kinds of medical office buildings in Europe and New Zealand and Australia. They also, at least I believe they did own something in the UK, which maybe they sold, and So they really expanded fast and went all over the world and took on a bunch of debt and paid a very big dividend, and then it all didn't work out very well for them. And so the whole board and management team, or many of the management team and board, got replaced. And so they're a much leaner organization. They've been curtailing their footprint and really driving synergies. We like their international footprint because in the international space, in those buildings, they sign very long-dated leases with inflation escalators. In Canada, to my knowledge anyway, the last time I looked, the leases were a lot more short-term. So it's an interesting business. I think that the new management team is doing a good job. At this price, yeah, it's okay. It's not a screaming buy, in my opinion. Now, the thing is, there have been rumors that somebody in the private equity space may want to do a takeover bid and then synergize with another group of properties, and maybe in their hands it's worth more than what the trading price is today. Don't know. At this price, I think you'll be okay if you buy it and just want to hold for the dividend. Don't know about much price appreciation. If you really want to enter it, I would wait for a pullback if you can.
Okay. All right. That was Gulam. Let's go to Joe in Montreal with a question today. Hi, Joe.
I want to ask you guys about Bank of America. With the tariff wars perhaps ramping up, what effect would this have on an American bank? And should people who have this in their non-registered account think maybe about converting over to a Canadian bank? Thanks. I appreciate your help.
Thank you for the question. Yeah, I mean, difficult times because Donald Trump, there will be deregulation. Some of the financials will do well, but there are other things hanging around. So how do you feel about banks in the U.S. versus banks in Canada?
So it used to be that the banks in Canada were a lot more expensive than the banks in the U.S. The banks in the U.S. have rallied quite a bit. So now the dichotomy in terms of valuation is not as steep. The difference, I think, is that the banks in Canada will have, and probably will have, a premium valuation because there's only 6. And they all command a very big proportion of market share. Having said that, Bank of America is no slouch. To my knowledge, they have 1 in 2 households in the United States in terms of some kind of banking product or some kind of relationship. Brian Moynihan is an amazing manager, and I think that Bank of America has done an amazing job in terms of getting out of the rut, I should say, that they had, and increasing return on equity, increasing earnings per share, and just running the business in a very good manner. Their underwriting is second to none, I would say. And they're dealing in a country where the domestic economy is really chugging along. So taking the politics out of it, unless you believe that the domestic economy in the U.S. is about to fall off a cliff or downgrade substantially, Bank of America is probably going to do well. I don't know that I would tell you to sell your Bank of America to buy a Canadian bank, because these are 2 different businesses, plus there's a currency issue and maybe even a capital gain issue if it's in a non-registered account. I would say that probably Bank of America has more upside, and I would probably favor you holding on to Bank of America rather than necessarily selling it, potentially triggering a gain and going into one of the Canadian banks.
Okay. Let's move on and get to our last caller today, Eddie in King City, Ontario. Hi, Eddie.
Hi, good afternoon. Thanks very much for taking my call. My question for your guest is ARC Resources and natural gas in general. Listen, natural gas is up. It's over $7. It's up over probably 70, 80% in the last 3-4 weeks. What do you think of ARC Resources? Let's say just for a trade, is it a good time to buy it and get in and out and make some quick money? Thank you very much, and I'll hang up and listen to you.
Is there quick money to be made in ARC Resources?
So, Eddie, I'm very sorry to tell you I'm not a quick money guy, so I don't know about quick money. We're value investors. We invest for the long term. Sometimes we get lucky and we buy something and it goes up a lot and we'll sell it and take the profit, but that's not how we typically invest. I've known ARC Resources since 1999, 2000. I've followed the company for a very long time. I think it's an extremely well-run company. I like what they've been doing with their assets. They not only have natural gas, they have diluent, they have different businesses in a very safe geography. They did have problems in their Attachie property, and I think that's why the market has soured on the name because of the water cut levels. So that's going to have to be fixed. And I think that the management team is strong enough there to fix whatever issues they've got in the geology and figure it out. The other issue is you're quoting a natural gas price in the U.S. Remember, in Canada, we're a little bit more landlocked than the U.S. in terms of the transport of natural gas. It's getting better with LNG Canada, but we don't necessarily benefit from that high price that you see quoted on the screen. So don't expect that to translate into free cash flow for a name like ARC necessarily, or not to the same degree, I would say.
Okay. Let's take another quick break then. We have new top picks coming from Mike when we come back. Join us tomorrow for a market call. Martin Cobb will be with us on the show. He's Senior Vice President Equities at Lorne Steinberg Wealth Management. He'll take your questions on global and North American equities. Time now for new top picks from Mike. We're going to start with MTY Food Group. MTY on the TSX own a number of different, very popular brands. People would know Yogan Fruz is my favorite. Mr. Sub is another one. Mucho Burrito might be your favorite. What do you like about MTY?
So we like the franchise model because, you're mostly dealing with royalty revenues at the top line. They don't own a lot of the restaurants. They're mostly owned by franchisees, and they own the brand. They own some distribution centers. They own some food prep, but really they own the brands, and they get that revenue in, right? And then they grow the brands. And, this company started with almost one or two brands, and now it's like over 90, and they're big in the US, and they've made all these acquisitions. Now, the stock price fell a lot. We think because, one, the market was maybe worried that they couldn't grow by acquisition to the same degree anymore. Secondly, maybe, with the delay to return back to the office, a lot of food
courts.
No
one was eating out.
Right. So, but we think that's all coming back now. And at the same time, management in November, December, said, hey, we don't like where the stock price is. We think we're worth a heck of a lot more. We're initiating strategic alternatives, which is code for we're either going to sell something and maybe pay down some debt, buy back some stock, or maybe the whole company is going to be sold. In the meantime, I think it was last week they just announced a huge dividend increase, right? So you're getting a great dividend. You're not paying a lot in terms of earnings. Management is key, great brands, and we think it's really undervalued, lots of margin of safety.
Okay, that's MTY. Let's get to your next pick, HP Inc., HPQ on the New York Stock Exchange. Pretty well-known name. What do you like about the company?
So this is not a sexy, flashy business. They make computers, they make hardware, they make printing, right? But, this is one of those iconic brands that's been around forever. And, when a lot of people need to replace their laptop, how many brands are there? Acer, Dell, HPQ, like 3, 4, 5. They have a huge market share. Now, what's interesting is it's currently trading at less than 7 times forward earnings, less than 7 times forward free cash flow. It's got a yield of about 6%.
I was just looking that up.
And so, we're looking at it saying, well, maybe the business doesn't grow a lot, and maybe there's not this huge upgrade cycle. But if they can only increase their margins by 1% on the computers and maybe 1% on the printing, that could add $500 million to $1 billion to the bottom line, which is 25 to 50 cents of earnings, right, and free cash flow. And this company has bought back a ton of stock, almost half the shares in the last 10 years. So if they do the same thing in the next 10 years, well, arguably, even if the business doesn't expand, the earnings per share are going to more than double from where they are today. So we think that this is a pay while you wait story, and lots of upside and lots of margin of safety.
Okay, HPQ, let's move to your last pick. Lincoln National Corp on the New York Stock Exchange. Tell me about Lincoln.
So Lincoln has been around for 120 years. It's a life co, but they do a lot more in the retirement products industry sector, rather, disability, life insurance, and also on the asset management side through insured annuities. There was a management change about 2 or 3 years ago. They had an issue with their balance sheet because of the rapid rise in interest rates, so their book value got knocked down. We think management is fabulous. You're getting a company that we think is on track to earn $8 a share. We think they can get to 10 in the not too distant future. So you're now paying 5 times earnings, 5.1 times earnings on a go-forward basis. You're getting a huge dividend yield. Their RBC, which is the regulatory-based capital, is over 420%, well over what they need in order to give them comfort, which tells me 2 things. We should see either some dividend increases or some share buybacks or a combination of the 2. In the meantime, you're getting a business that's trading extremely cheaply compared to its peers, and it's a very well-run, very well-financed company.
What else would be in its sphere, competitor size-wise?
Prudential. Well, Prudential's much bigger, but okay. Prudential, MetLife, Corebridge, maybe Jackson Financial, a bit of a smaller competitor. So there are quite a few competitors, but in terms of valuation, quite cheap. And again, you get paid while you wait.
All right. Got to leave it there, Mike. Thanks for joining us today. Good to see you.
Thank you for having me.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.